Ladies and gentlemen, 25 major banks just held an emergency meeting with the Federal Reserve after this critical signal was just triggered. Because this past month has been a month unlike any other. We had this news that BlackRock faced 100% loss on private credit loan, adding to credit market pain. Tricolor went bankrupt, and this is causing lenders to reassess risks. First Brand's bankruptcy, how a $10 billion auto parts collapse exposed hidden dangers in private credit markets. UBS winds down O'Connor funds in sign of First Brand strain. Sonder gets abruptly evicted after short-term rental company goes bust. And OpenAI backtracked after their CEO was saying, look, we need a government bank stop because things are very, very wrong. And just in as I'm recording this, we saw foreclosures jump 20% in October, a sign of more distress in the housing market. So people, this is a critical update that everything is not okay, unlike they may want you to think. We are seeing cracks in the financial system, in the banking system, and the signs are everywhere. And the signs are getting so big and so loud, you simply cannot ignore it anymore. And you need to know exactly what is happening right now, why these banks just held this emergency meeting and did not want the press to know until the press actually leaked this meeting with the Federal Reserve, what they're discussing in this meeting, and what signal was just triggered to show that things are very, very wrong. Because people, before every crisis, there is always warning signs. All you have to simply do is go out there and look for them and research them. Many people are just, passively going throughout their lives, watching the football. They have no idea what's going on. But if you watch this video, you'll be well prepared. So everyone, this is going to be a very, very important update. So let's not waste any time. Let's get straight into the news, the facts, and the data. Well. Okay, look at this, everyone. New York Fed convened meeting with Wall Street firms over key lending facility. This is what I've talked about on the channel, and I've been warning people that this is going to happen. And I've been warning people about a month in advance before the New York Fed actually held this meeting with these banks. But now they're getting 25 of the biggest primary dealers in America together to say, okay, what's going on in these money markets and how can we fix it, because time is running out. So like I was saying, everyone, the hastily arranged meeting, which was not previously reported, that's right, because what's the biggest issue for the banks? It is trust in the banking system. The bank does not have any reserves. If they're lucky, they may have 10% in reserves. If there is a panic and everyone all of a sudden tries to pull out their money, the banking system would collapse very, very quick, like what we saw with Silicon Valley. This took place on the sidelines of the Fed's annual Treasury Market Conference on Wednesday, according to 3 people familiar with the matter. It comes at a time where banks, investors, and officials are concerned about signs of stress in an arcane but vital corner of the US financial system. So what exactly is this system and why are they so worried? So Williams solicited feedback from primary dealers, mostly banks that underwrite the government's debt, on the use of the Fed's standing repo facility, which I did a video a couple weeks ago about how this spiked to an unprecedented level, and I'll show you that in a moment, which central bank officials describe as a crucial pressure relief valve to help them keep short-term borrowing costs within their target range. Now, also like I talked about on the channel, the SOFR rate, this is the standard overnight rate for the banks to borrow or lend to each other, and the repo market is pretty much like a pawn shop for the banks. They will give them collateral for an overnight loan, kind of like a payday loan, where you might take your guitar or expensive jewelry to the pawn shop, and they'll give you some emergency cash with interest attached. So like I was talking about, a representative from many of the 25 primary dealers was in attendance. The people said they noted that the attendants were broadly members of banks teams specializing in fixed income markets. So again, they're getting the 25 most powerful, influential banks in America together to figure out how can they fix this crisis, because things are getting far, far worse. So a closely tracked measure of short-term borrowing costs, known as tri-party repo, jumped well above the rate set by the Fed last month, but then eased back following the week as investors took solace in the central bank's pledge to stop shrinking its balance sheet on December 1st. So that's exactly right, everyone. The only reason why the Federal Reserve announced that they're going to stop quantitative tightening, that just simply means selling assets on their balance sheet, which makes interest rates go up. They all of a sudden had to make a U-turn, not because inflation is, all of a sudden gone. It's because there was massive cracks in the banking system. And this happens every single time. We saw this happen in 2019. And after 2019, we had the repo crisis, and then we had a big stock market crash in 2020. So Robert Polari, the head of the New York Fed's market operations, acknowledged this week that some borrowers have struggled to secure repo rates close to the level of interest paid on reserves parked at the US Central Bank. Now, I know this may sound a bit technical, but we're going to break it down in very simple terms in a moment. The share of repo transactions are taking place at rates above the interest rate on reserve balances, and that has reached levels not seen since late 2018 and 2019, like I was talking about during the 2019 repo crisis. Repo transactions in which high quality collateral is exchanged for cash on a short-term basis provided essential lubrication for the financial system, and the rates on these transactions are closely watched by policymakers. Because if these rates spike, that means there is huge stress in the financial system. But more importantly, what it means is the banks are running out of cash and they're running out of liquidity. Analysts have warned that they expect further bouts of pressure in the coming weeks. After 3 years of quantitative tightening, banks have little excess cash. Again, this is very, very concerning. A condition that will only worsen as year-end approaches and they reduce the size of their balance sheets for reporting purposes. This is something we have to watch very, very closely, people, because I'll bring up a chart here to show you that things are very, very wrong. So we can see here, US money markets has faced bouts of strain in recent weeks. And this is where I did the video on the repo markets, where it spiked all the way up to $30 billion overnight that these banks had to borrow from the Federal Reserve because they had no money. Now, the New York Fed president said earlier this week he viewed the recent use of the facility as effective, adding that he fully expected it would continue to be actively used and contain upward pressure on money market rates. But the big issue with this facility is, if you use this, people may start to look at the banks that are using the facility and go, is there something wrong with this bank? Why are they having to use a Federal Reserve facility? Is my money safe in this bank? Should I pull my money out? And this could cause a bank run. Because it says here, lenders often loathe to use a facility, fearing that it could signal to the market that their institutions are under pressure, even though the names of the borrowers are only made public 2 years after they tap the facility. So this is very, very concerning, everyone. Why do they not want the public to know what banks are using this? We should be able to know, so we know if our money's safe or not. If any borrower gets the reputation of being riskier, it creates this perverse incentive for all the lenders to pull back at once, even if not deserved. Once you get that stink on you, it's hard to recover, he said. So that's exactly right. Once these banks realize that liquidity is drying up in the banking system, they're going to stop lending and stop giving their money out because they know there is going to be very tough times coming ahead. So again, people, we're seeing bankruptcy after bankruptcy, like what we saw at BlackRock with one of their loans going bad, Tricolor, First Brands, UBS, Sonder, and even OpenAI asking for a government backstop. Foreclosures are skyrocketing, so this is saying something is very, very wrong in the banking system. But the big difference this time compared to last crisis is, before, the Federal Reserve could just drop interest rates to zero and announce QE infinity. That's what they announced during 2020, during the pandemic. They said we'll print as much money as we need in order to save the markets. But the difference this time is we have high inflation. So they can't just simply drop interest rates to zero very, very quick and all of a sudden do quantitative easing very, very fast like they did before, unlimited QE, without causing mass inflation. So this leads us to only two scenarios. One, the Federal Reserve doesn't bail out these banks or these institutions that are going bankrupt, which I think they shouldn't. If you're a business, you took on the risk, well, you got to pay the consequences for taking that risk. You can't just have all the upside from taking high risk and then all of a sudden your investment goes bad and then all of a sudden you have to ask for a bailout. No. If I take a high risk investment and all of a sudden I go bust, can I go to a central bank and get a bailout? No, and neither can you, so we need to let these banks fail. But I think if we go over history, what they've done in the past, they've always sacrificed the middle class. They've always sacrificed the small business in order to bail out these big businesses, and they've printed money and dropped interest rates, and this causes mass inflation. So while I think they will act slower this time compared to 2020, I think inevitably they will step in there to try to save the banking system, and this will cause mass inflation. Now, a second topic that I want to talk about is on our channel, we've covered some of the most incredible events ever. And in the coming minutes, I want to share with you a huge opportunity in my book, which includes DHS, CIA, TSA, MIT, and its Lincoln Laboratories, DOE, and PNNL, CBP, and the White House Secret Service, and more. Because this opportunity includes exclusive licenses, cutting-edge patients, $1 billion exit game, changing government mandates, and sole source contracts, as well as the Los Alamos National Laboratory, international airports, and a stock trading near all-time lows. With a market cap of 17 million USD, even after raising 45 million and spending the funds on breakthrough products. And that's why I want to talk about today's video sponsor, Liquidity Defense, that stock ticker symbol LDDFF. Because just in the past month, Liquidity Defense has expanded into new international jurisdictions, signed as a customer one of the largest US-based airports in the world, closed multiple sales, and I want to give you an urgent update. Shares of LDDFF are available on Interactive Brokers, Schwab, Fidelity, and E-Trade, to name a few. Despite it all, Liquidity Defense stock is down 85% in 8 months. Now get this, Liquidity Defense raised 45 million to date, and its current market cap is only 17 million. With the 45 million, its management has developed and began commercializing one of the most competitive and innovative products of its kind, in my opinion. In accordance with Trump's TSA mandate and DHS requirements to make Americans safe and airports efficient and much more travel friendly. Over the years, Liberty's Defense raised millions of dollars at share prices of 2, 3, 4, 5, 10, and 12 times the current price it is today. It raised 3.5 million in Q1 2025 at 5 times or 500% higher than today's price. In October 2022, the company raised 5.1 million at $2.75 a share, compared with 33 cents Canadian today. In May 2023, the company raised 2 million at $3 a share, compared with 33 cents Canadian today. And this is why this video is so important, because Liberty's Defense trades near all-time lows. Now, this is the most important part. Liberty's Defense is working closely with Trump's TSA in what could be a game-changing moment for the company. I want to explain the upside potential and catalyst for Liberty's Defense, because you see its products are being consistently sold to new customers. Hexwave, from my standpoint, the most important reason I'm featuring Liberty Defense to you now is because the TSA has issued a mandate that airports must, and I repeat, must begin screening employees for explosive type threats, including metallic and non-metallic threats. Hexwave was derived from cutting-edge MIT Lincoln Labs, researched and enhanced through partnerships with the US Department of Homeland Security and Transportation Security Administration. Hexwave is a walkthrough portal that uses millimeter wave technology, advanced 3D imaging, and artificial intelligence to detect both metallic and non-metallic concealed threats. So unlike traditional metal detectors which fail against plastic or 3D printed weapons, Hexwave scans individuals in real time as they pass through, processing up to 700 people per hour without requiring them to remove jackets, shoes, or items in their pockets. And get this, Liberty Defense developed it, even winning a $500,000 award from TSA, and commercialized the Hexwave in September 2023 with a price tag of $100,000 per unit. One of the first few customers to purchase the units was the Los Alamos National Labs, but most incredibly, new development occurred when the TSA issued a mandate for roughly 173 airports around the country to screen their employees starting April 2026. Now, Liberty Defense has also won a sole source contract from the TSA to develop an upgrade kit to the existing millimeter wave based body scanners at the airport. As the TSA starts upgrading these airports over the coming years, this could generate over 100,000 in potential sales for Liberty Defense. Now, backed by the US Department of Homeland Security, co-developed with scientists at Pacific Northwest National Laboratory, funded in part by a TSA innovation grant, and already awarded a sole source contract to upgrade, develop checkpoint systems, the HD AIT kit represents the future of aviation security. With more than 1,000 units deployed across the US alone, but these machines are already showing their limitations. Rather than scrapping thousands of existing machines, the HD AIT kit retrofits current AIT scanners with new imaging hardware, advanced signaling processing, and AI-based threat recognition. The result is like turning a 1990s TV into a modern 8K flat screen. Just so we're both on the same page, the TSA has awarded Liberty Defense a sole source contract, and the patent technology is exclusively licensed to Liberty Defense. What this means, at an estimated cost of $125,000 per upgrade kit, and with 1,000 units in need of upgrading in the US, and another 600 to 1,000 abroad, is that for a company with a current market cap of 17 million, the upside potential is enormous, at least as I understand it. So go ahead and start doing your due diligence on Liberty Defense today. So everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.